Hello, welcome to the first class of the course Advanced Financial Accounting. And when we talk about something being advanced, that means there is a basic aspect, which is the beginner, the intermediate, then the advanced, and that is why we have the Advanced Financial Accounting. We've been able to look at the basic aspect of it in the financial accounting one, and this is an advanced course for financial accounting. And today we will look at advanced review of financial accounting principle. Advanced review of financial accounting principle. Under this, we will understand the conceptual framework for financial reporting. We apply fundamental and enhancing quality characteristics, and also we recognize and measure assets, liability, and equity. And we will be able to apply revenue recognition principle under IFRS 15, differentiate between accounting policy and estimate, account for provision, contingencies, and prior period error. We will also compare key differences between IFRS and US GAAP. And lastly, we exercise professional judgment in financial reporting. This is actually going to be a brief one because we have the full notes with examples there. By introduction, advanced financial accounting begins or builds upon foundational accounting knowledge to explore complex transactions and reporting requirements. And this module prepares professionals to navigate the intricate landscape of financial reporting in a globalized business environment. Modern financial reporting requires the exercise of professional judgment and the application of complex accounting standard. And this module actually emphasizes the theoretical underpinnings that guides contemporary accounting practices. Moving to the conceptual framework for financial reporting, the conceptual framework, as developed by the International Accounting Standard Board, provides the foundation for developing consistent accounting standard, and it guides preparers and auditors when addressing accounting issues not specifically covered by existing standard. And the framework also assists International Accounting Standard Board in developing standards, help preparers develop consistent policies, and support professional judgment. And it is also important to note that the conceptual framework does not override any specific IFRS standard. Let's look at the fundamental qualitative characteristics. We have two characteristics. We have the fundamental and we also have the enhanced, and under the fundamental we have the relevance, and this means that financial information is capable of influencing the economic decision of users, and relevant information has predictive value, confirmatory value, or both. And under faithful representation, which is another qualitative fundamental qualitative characteristics, it ensures that financial information is complete, neutral, and free from material error. And faithful representation reflects the economic substance of transaction rather than merely their legal form. Looking at the enhanced qualitative characteristics, we have the likes of the comparability, which enables users to be able to identify similarities and differences across periods and between entities. We also have the verifiability, which helps assure users that information faithfully represents the economic phenomena it claims to depict. And also we have the timeliness, which requires that information be made available to users while it is still capable of influencing decision, not after everything has gone and then it's been provided. No, it must be a timely one. And last one is understandability, which means information is presented clearly so that users with reasonable knowledge can comprehend it. let's look at the element of financial statement. And when we talk about the element of financial statement, we have the assets, we have the liability, and we have the equity. Talking about the asset is actually a present economic resource controlled by the entity as a result of past events. It's present economic resource which is actually controlled by the entity as a result of past events. And also for the liability, it's a present obligation. Note that the asset is economic resource. This one, it's actually an obligation of the entity to transfer an economic resource as a result of past events, and this one means that they owe someone. So the asset is owned, while the liability is actually they owe someone. And looking at equity, it is the residual interest in the asset of the entity after deducting all its liability, and the recognition of these elements occur when they meet the definition and provide useful information to users. As per the recognition of revenue, we see that IFRS 15 gives this, and it's actually a 5-step model. And the first model involves identifying the contract with the customer. The second one requires identifying the distinct performance obligation within the contract. The third involves determining the transaction price, including variable consideration. Step 4 requires allocating the transaction price to each performance obligation. And lastly, which is step 5, it involves recognizing revenue when control and goods or services transferred to the customer are transferred to the customer. Let's differentiate between accounting policy and estimate. When we talk about accounting policies, these are actually specific principles and methods which are applied in preparing financial statement. They are specific principles and methods that are used in the preparation of financial statements, while accounting estimates are actually the monetary amount subject to measurement uncertainty, such as useful life or warranty cost, and changes in accounting policy are applied retrospectively as if the new policy had always been used, and changes in accounting estimates are applied prospectively, affecting only current and future period. Let's also look at provisions and contingency, which is IAS 37. For this, a provision is recognized when there is a present obligation, an outflow is probable, and a reliable estimate can be made. And as for a contingent liability, it's actually a possible obligation that is disclosed but not recognized in the financial statement. For contingent assets, it's a possible asset that is only recognized when realization is virtually certain, and provision are measured at the best estimate of the expenditure required to settle the obligation. Let's look at correction of prior period errors. Prior period errors are corrected retrospectively by restating comparative financial statements. As per the restatement, it actually involved adjusting opening balance of assets, liability, and equity for the earliest period presented. An entity must disclose the nature of the error, the amount of correction, and how it is corrected. And as per the retrospective restatement, it actually may be impracticable if the effects cannot be determined after every reasonable effort. Looking at some key differences between IFRS and US GAAP. This can be looked at in terms of LIFO, which is last in, first out, inventory valuation, and this is prohibited under IFRS but permitted under the US GAAP. For the revaluation of PPE, it's actually permitted under IFRS but generally prohibited under the US GAAP. And for development cost, it may be capitalized under IFRS if criteria are met but are generally expensed under US GAAP. And lastly, impairment reversal is permitted under IFRS except for goodwill but prohibited under US GAAP. In conclusion, advanced financial accounting requires the application of professional judgment within the framework of accounting standard. An accountant must balance technical knowledge with ethical responsibilities to ensure transparent and reliable reporting. Financial statements serve as a critical communication tool between entity and their stakeholders, and having a mastery of these principles prepares professional and you as you go on for the challenges of modern financial reporting and decision making. Thank you.